Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliette Sarli. Great to have your company on a very volatile day's trade. Let's have a look at where we are closing out the session. Only marginally higher at the close, about a tenth of 1% on the CBO 200. Similarly, on the ASX 200, in fact, we're just a little bit weaker than that, only up 5 points heading into the close, 8,585 points. You can see that drop that happened just ahead of the GDP print. But then when it was released, we actually saw quite a bit of a spike and some buying coming through, which has petered off into the afternoon. I think that's really as traders just assess the implications of this report. So GDP rising just 0.4 of 1% in the September quarter. Expectations were for 0.7% growth. But then when you dug a little deeper, it does seem that the other figure for the previous quarter has been revised up. The annual rate 2.1, just below 2.2% that the market was looking for. And it does seem that the economy is pretty much running, I guess, at full steam. So that expectation that maybe we'd get a rate cut because the economy wasn't growing strongly enough seems to have petered out somewhat in the afternoon trade, but very, very volatile session. And of course, that brings us to the themes of the day, that low gear GDP. Also a bit of a contrast here with the tech sector. We did have a bit of upside momentum in IT stocks, but not quite what you saw coming through on Wall Street overnight, where the Nasdaq was up by some 0.6 of 1%. And of course, all leading to a struggling day for the market. Let's look at some of the sectors. Uranium stocks did very well today. You can see Boss Energy, Paladin, Deep Yellow, all looking very solid. We also saw some pretty good upside in utility stocks today. AGL up by 3.5%. The industrial stocks, though, was one of the weaker performers. You can see there SGH, Brambles and Reliance Worldwide, the sector off by about a third of 1%. Healthcare also switched out today by about half of 1%. When it came to some of the other company news, we were looking very closely at real estate stocks as well on the back of interest rate expectations. Centre there up by 1.2%. Transurban as well. Now it came through with an update today. It also said it will distribute a 34-cent dividend for the last 6 months of 2025 and reaffirmed its full year 26 distribution guidance. Block, though, did fall. We mentioned their tech failing to follow those gains coming through on Wall Street. 4DS Memory, that's actually 4DS Memory, and is my error. I meant to put in 4D Medical, and it was actually higher today. The health technology giant Philips placing an order worth $10 million US, and Vulcan Energy still in a trading halt, but it did secure a 4 billion European Union financing package to develop its Lionheart Lithium project. All right, never wrong for long. Let's welcome to the COB Cliff Bennett from Propex24.
Hello, Juliette.
Hi, Cliff. Good to see you. So what did you read into the GDP print, and I guess what it means for the RBA?
Well, yes, I think sadly for Australian families, they are going to be waiting longer for a rate cut. But to me, the GDP data allowed for a rate cut. And as you know, I've been very much suggesting that rates should already be at 2.7% or 2.5% without any impact on inflation. But the GDP data today, we saw a sharp slowing in discretionary spending. Household spending was down. And this is why all the time, while households are having to spend more, they're being forced to spend more in terms of electricity and medical and other costs. So I think it is, again, highlighting that some sectors doing particularly well, such as capital expenditure spiking up 2.9%, largely driven, as the Bureau of Statistics said, by the AI boom, bringing in equipment, purchasing equipment to build data centers and the like, which won't necessarily benefit the whole society straight away, but certainly it helps with the GDP numbers, and certainly it's a good long-term investment. But government infrastructure spending was up 3%. So a lot of this, and overall public sector administration contribution was 0.8%. So we remain in a situation really where public sector spending is way too high. and to some degree maybe crowding out the private sector. Meanwhile, in the private sector, we saw manufacturing GDP down, industry GDP down, and in fact, manufacturing and industry have been falling for some 2 to 3 years now and are down 3 to 4%. So the economy does have significant problems. Households showed in the data that they have significant challenges, and inflation is not from an overheating economy, as I keep saying, because we have to remember that the Australian economy is now really probably, apart from that 0.7% spike to the upside, settled in a kind of 0.2 to 0.5% quarterly range outcome. But pre-COVID, the range for the Australian economy was, for many years, really around the 0.4% to 1% GDP growth per quarter. And so we're running at half the pace. The Australian economy, and this is something a lot of people miss, even with one of the world's largest immigration rates, which will have its benefits long term, the Australian economy is running since COVID at about half its pre-COVID level. So there are things that are wrong in the Australian economy, and everyone keeps trying to hype up, oh, but it's growing. Yes, but it's growing more slowly, and it's growing in specific sectors and in the public sector, and the private sector growth remains very lackluster, and I think really does justify aggressive rate cuts from the RBA, but someone needs to appoint me governor.
Yeah, well, absolutely. And you've been saying that for a while, but it does seem actually now that there's even more chatter that if there's going to be a move in 26, that potentially it would be a hike. I get to ask the questions to the governor next week. Clifford, what do you think I should be saying?
Very good, Gillette. You should ask the question, does the RBA feel that inflation is occurring because of an excessively strong economy, in which case monetary policy has an impact? Or is it coming from other directions, in which case monetary policy may not be quite the tool that it once was with regard to inflation?
All right.
That would be my pitch. Might be a bit too much.
It's a good thought. I'll have a think about that one. And I guess, what is sort of next in terms of what we're focusing on? It's all going to be about the Fed in December. They are likely to cut. And does that just give somewhat of a divergence? Or to Michelle Bullock's point, we didn't hike as fast, so we didn't have to cut as much?
Well, I think there have been two similar stories, but still distinct stories. We don't have that tech revolution, although it was very good to see Vulcan Energy moving ahead today. That was fabulous news. But we don't have quite the same depth of technology revolution in this country that we're seeing overseas. And also, I think, the Australian situation has been that the RBA left interest rates near zero for far too long, which caused a property and asset market boom. And then it hiked rates too far. It was late and hiked rates too far. And now it's been unwinding that too far somewhat, but it needs to do it a lot more. So I think what's happening in the US is the Federal Reserve's a little bit smarter on inflation than the RBA. Well, I mean, every central bank in the world's a little bit smarter than the RBA, but they are a little bit smarter on the contemporary nature of inflation, which is very different to, the last century. So those last century textbooks need to be thrown out. So what I'm saying, though, is that the Federal Reserve is aware that inflation is not under its control and not from an overheating economy in the way that it was in previous decades. And if the labour market is in trouble, they should be cutting rates to support the overall economy. They've suffered a wealth gap expansion the same way as Australia is, but even more so and more devastatingly in the US. So the bulk of the American public are badly in need of rate cuts. And my hat's off to the Fed that they're a little bit late in doing so, but they're recognizing the pain in their society and cutting rates even with stubborn inflation, if not accelerating inflation. And we're still not sure how the tariffs will sort of unfold long term in the US economy. That's going to be a background inflation noise, if you like, for some time. But in Australia, the RBA just keeps thinking, oh, if inflation is high, we need to keep rates higher. But that isn't the case. You can lower rates without an inflation impact And I think there is a wealth gap expansion that has occurred since COVID in Australia, and the RBA needs to pay more attention to that in terms of supporting small families and small businesses.
All right, Clifford, thanks as always for your insights. Have a good afternoon.
Thank you very much, Juliet.
Cliff Bennett from PropX24. All right, let's get back into equities. The stock of the day was WiseTech, and Andrew spoke to our experts, Michael Gable from Fairmont Equities, Philip Pepe from Shaw & Partners.
Just wonder how far the rally can last before it rolls over again, unfortunately. So, yeah, you just can't fight the market sometimes. So, look, I'd have it as a hold if I was in it. I think it's good value. The business is doing really well. It's got a bit of short-term upside, and then I'll just have to take it from there, but maybe not enough to be buying a new position.
My guess is a number of funds who have ESG as a screen have just sold out and can't buy back in. And that's presented the opportunity we have today, that a company that's fundamentally sound, operationally, it's got strong offering, strong market position. Analysts have got it growing at 35-40% per annum over the next 2 years. So nothing wrong with the business. It's whether or not, if you have an ESG screen, can you invest in a company that's founder-dominated issue? We've all read about the issues. It's never looked cheap. It's the cheapest it's been in quite a while. It is averaged, and I can't believe I'm saying this out loud, it's averaged 80 times PE over the last 5 years, 80 times, 80. Currently a bargain at 60 times. So, you know.
All right, let's have a look at the winners and losers in today's trade, and Boss Energy, Bellevue Gold, Deep Yellow, Paladin, and of course WiseTech there as well. It really was a day mainly driven by those uranium players. Having a look at the laggards today, Megaport, so that tech sector sell-off, Megaport block down, Light & Wonder and West African Resources as well. In the small end of town, Atomic Eagle had a good session, up some 19%, a little bit of a lithium love there as well. Investigator Silver too. And to the downside, we had weakness in Robex Resources, off by 13%. And just as I was saying, lithium is doing well, Atlantic Lithium there proving me wrong with a 9% drop. Tonight we get US ADP private payroll data, also industrial production for September, import and export prices for September, and some earnings from Salesforce, Snowflake, Dollar Tree and Macy's. Tomorrow, goods and trade balance for October, a $3.9 billion surplus expected. The household spending insights indicator for October, spending expected to have increased by 0.6%, and Rio Tinto holds at Capital Market Day. Let's have a look at where the local market has finished, just 0.1% higher there on the CBO 200, and I'll just get you a quick check on the ASX 200, which went into match off only 5 points higher. But it has managed to gain a little bit more ground on the close, up 15 points, 0.2%, 8,595 points. All right, we do it all again tomorrow from 9:45 a.m. Eastern. Join us then.